On today's episode of Founders and Fortunes, I sit down with Scott Hauck, a rare kind of private equity fund manager. He's not a Wall Street guy, but he's far from the trenches. After scaling and exiting multiple companies, including Galileo, which was acquired by SoFi for $1.2 billion, Scott launched Legacy Capital to do what most funds can't: operate from the inside. Today, we talk about the $10 trillion silver tsunami, why operator-led private equity is winning, and how Legacy is acquiring profitable, overlooked businesses and distributing returns to LPs from day one. If you've ever wondered what separates financial engineers from real operators in private markets, this is the episode for you. Welcome back to Founders and Fortunes, the show where we explore the people, ideas, and capital shaping the future of private markets. Today's guest is Scott Hauck, general partner of Legacy Capital and someone whose journey from hands-on operator to fund builder offers a rare glimpse into what it really takes to scale companies and protect founder legacies. Legacy Capital is built to capture one of the biggest generational transitions in American business history, the silver tsunami, acquiring profitable, founder-led businesses overlooked by traditional private equity. But what makes Scott different isn't just his sourcing machine or his short duration model. It's his operating DNA, his builder's mentality, and his clear purpose beyond profit. Scott, welcome to the show.
Thank you so much. Appreciate it.
Yeah, pleasure having you, Scott. Let's take a step back and look at the start before Legacy Capital. Where did you grow up? What kind of kid were you? Curious or competitive? You tell me.
Both. I grew up in a rural town just outside of Boise, Idaho, and kind of had a sandlot. If you've seen that movie, a sandlot upbringing. Played a lot of baseball, got very competitive. I was always at the city pool hanging out, just like the Sandlot movie. It was kind of my childhood, and I loved it. Rode our bikes everywhere back then, hang out with friends, and to get into mischief and do all sorts of fun things. I had a great childhood. When I was a teenager, I moved to Salt Lake City, and I've moved around a little bit more. I've lived in Phoenix and Memphis, but now reside in Salt Lake City again and have been here for the last 10 years. 4 kids. The oldest is a senior in high school. She'll be graduating this May, and then I've been married for 20 years.
Nice. And it sounds like a nice childhood, like suburban type of upbringing. Yeah, riding bikes around the cul-de-sac. And I had a similar, childhood as well. Was there a defining moment in your life, small, big, otherwise, where you realized that, you know, you're more of an entrepreneur?
Yeah. I years ago, I was working for corporations and, did a lot of private equity deals, helped those companies grow, and some of them exit, either get acquired or go IPO. And I found my niche working at digital marketing agencies. There was a lot more freedom. There was a lot more, different types of projects you could work on, different types of clients and industries. And that's where I really started to enjoy the entrepreneur side of things, because there was just more freedom with how we could build out strategic plans for different companies. And I owned an agency, was a partner at an agency for about 7 years prior to starting Legacy Capital. And that's what we did. We basically took our clients and we built them up, and we helped them achieve 3 to X returns on their businesses over 2 to 3 years. Finally, with Legacy Capital, decided to do it for myself with my own businesses, acquired through the fund, and here we are.
And which was the first marketing agency that you're referring to? Because I know you've worked with several.
Yeah, so I worked with Thomas Arts for a number of years, or TA as they're branded now. And with TA, we worked with companies like Zions Bank. We worked with Aetna. We worked with, trying to think of some of the other businesses we worked with. Some pretty, fairly large financial services companies and healthcare related companies. Then I went on and worked for MRM McCann. They're one of the largest digital marketing agencies in the world. With them, I worked with Cisco, Fitbit, Panasonic, Verizon, some big brands there, where we were able to really shape their corporate strategies, their digital marketing strategies and platforms. And then most recently, I was at a small agency called HyperX, where I was a partner for the last 7 years. And we worked with companies like Qualtrics and even some small and medium-sized businesses as well. But yeah, Big O Tires, Qualtrics, Galileo, SoFi, Unishippers, some pretty big brands. And they basically gave us full strategic control of how we could help them, or how their businesses and brands could be built over the next 1 to 3 years, and had goals in mind. We want to be acquired by a bigger company, or we want to go IPO, or we want to just achieve a certain amount of annual recurring revenue. And so we would help them build out the roadmaps for those goals, and then help them accomplish those, and achieve them over time.
And when early on, before, and I have questions about those companies too, because those are huge achievements from Galileo, Kelly, and is it Kel or Kel? Kelly,
Yeah.
Kelly, and Unishippers are some of the standout ones. Were there, maybe it was at TA, who was, would you say, is one of those mentors that really shaped your views on ownership, leadership, and responsibility, being a responsible operator?
Yeah, that's a great question. So when I was at Kelly, that was the first private equity deal that I worked on. And this was back in 2012 to 2015. My boss there, he was the CEO of Kelly. I also worked directly for the board of directors, who was the private equity fund that hired me, or the private equity owners that hired me. But they really taught me how to not only build a business from a financial perspective, but from, an operating partnership mentality, how to come in and view everything from the team, the finances, the different platforms they were working on, the sales and marketing relationship, everything, the manufacturing side of things, the warehousing, the shipping, and be able to break things down into a way that made sense from an ROI perspective. And then from there, build the different parts of the business that returned the greatest investment. So I'm grateful to the boss that I had there, the mentor that I had there, because he really helped me understand the importance of growing a business, building a business from not just a financial perspective, but looking at everything holistically.
And I am curious, what would your friends say is the most Scott thing about you?
I don't know. The most Scott thing about me,
Friends, family?
tough question, probably that I confidently go after things, like I'm very driven. I set my sights on a goal, and I go after it no matter what. Most of the time I achieve those goals, so I'm extremely driven. I try not to be, obnoxious or annoyed about it, but like I am competitive, but not like in a really obnoxious way. Um, I don't let my kids win at chess, because I'm trying to teach them how to play chess, and how teach them how to be strategic, and win on their own. But at the same time, I love teaching people. I love helping people raise the bar. Love helping people achieve their goals. I love building businesses, and I'm extremely driven in just about everything that I do. Be driven and ambitious, but if you do it in a in a way that makes you overly competitive or obnoxious to other people, then people aren't going to want to work with you. And in my business, in the private equity space particularly, like, you have to get people to like you. You have to get people to work with you. And if they don't want to work with you, then you're kind of, in a tough spot.
Yeah, absolutely. And let's lean in more on that building and exiting that you've done, particularly with respect to Galileo and Kelly and Unishippers. When you look back at those experiences, and you can summarize them too, because they're all impressive. What patterns or lessons stand out to you?
Or lessons. I mean, it really just, coming in on a new business, on a new acquisition, and figuring out how to grow that business takes a lot of discovery time. People want to just jump straight to strategy, but you can't do that. You have to come in, you have to understand the business, you have to understand the products and services, you have to understand the people, you have to understand the data, the finances, you have to understand everything. You have to basically become a master in that business by listening to the people that have built it so far, and then bring in your expertise on building businesses and helping them exit or achieve greater valuations over time to help them build that business. And you have to incentivize the right people within the business to help grow it. You have to find the different aspects within the business that drive the greatest return on investment. And as you do that, once you find the parts of the business that are not driving a great return on investment, you lessen those things, and you increase your spending and your focus on things that do drive a great return for the business, whether it's return on ad spend or, you know, a full team that, what does their return on investment look like at the end of the day? How much net value are they providing the business? You have to come in and look at things from a holistic point of view, do all the discovery work to fully understand it, become a master in that business, and then bring your expertise in from building other businesses and helping them go public or achieve greater valuations to really come in and build that business up.
And I think particularly in digital marketing, that can be difficult. You mentioned, ROAS, return on ad spend. It almost seems like there's two different types of marketing, right? You have the agency base where there's ad buying, there's ad spend. It's more transactional, and then there's thought leadership and building more of a grassroots following. Again, depending on the company, the person, there's thought leadership for different areas. What are your thoughts with regards to those different types of marketing? Kind of random, but I'm curious since you have had so much success in that space.
I've never taken a cookie cutter approach to any business. So any business relationship that I acquire, they come to me and say, "Hey, I need your help building my business. These are my goals." We help them with those goals. We help them achieve those goals. There's never like one model or cookie cutter way to build a business up. Every business is slightly different. Every product, service, the geography of it, the demographics behind it, like every business is slightly different. And so going back to what I was saying about discovery work, you really have to put in the time and effort to understand the business, the markets, everything, to come up with a cohesive strategy playbook that's going to work for that company over time. It's usually going to encompass a bunch of different things. It might include, paid advertising. It might include more organic advertising, SEO. It might include product marketing and updates to the way that they market their products, services. It might include, foundational things to their teams, to their, to the way that they approach their business and they approach different markets and different demographics. So for me, it's not just a marketing approach, which type of marketing works best. It's really what does this business need to grow? And let's come in and test a few things and build a hypothesis. And then from there, pull the right levers that are going to build that business over.
And agreed. A good answer there. And speaking to that, because you were brought in, these are huge companies. Well, Aetna was one of them, massive. But then with some of the smaller ones that you helped see an exit or helped grow, are there any moments or really difficult decisions that stand out to you throughout that process from coming into a company that's already moving and you're the guy that needs to improve it?
Yeah, I mean, coming at it from an agency standpoint, as an agency owner, when businesses come to you, there's usually a reason. They usually need help with something. And, you know, we, we would take the approach of building a relationship with the management team, with the C-level, operators of the business, really understand what their goals and aspirations were for the business, really understand the business from their perspective. But a lot of times, and just about every single time, as you're doing your discovery work, businesses or business owners will sometimes push back. They don't want you digging too deep on things. They don't want you opening every cabinet door and looking under the rug. Or I don't know if I'm providing the right analogies here, but
I know what you mean. Yeah, you are.
sometimes they don't like you looking under the hood. But you have to help them understand this is through relationship building that you have to look under the hood. You have to test everything. You have to understand their business. You have to understand all of the whys and how they go to market, everything about their products and services and why they do certain things. So you can come back to them with the best strategic recommendations on how to build that business and actually get them to sign off on it. It's funny because businesses and business owners will come to you and say, "Hey, I need help with my business. I want you to help me grow it. These are my goals. Help me define these goals, flesh these goals out a little bit more. Help me achieve these goals." But sometimes they don't want to change or they don't want to, update the way that they're currently doing business in order to achieve the goals that we work with them on. So building that relationship of trust and breaking down those barriers in order for them to be in a position to trust us to come in and execute on the strategy that we build for them is sometimes a challenge. And a lot of business owners do that. They built these businesses, they operate these businesses, they're very close to them, and they're trusting you with their baby. This is their child, and they want you to take good care of it. And sometimes, helping their businesses grow require sacrifice and different, very difficult changes to the way that they're doing things. Change can be hard. And business owners, they have to have that trust in me and trust in the process and be flexible and know that we have their best interests in mind. But sometimes growth is painful. And that's
Mhm.
just a fact of life.
Yeah, absolutely. Change, growth, requires a little bit of suffering. And it sounds like you've had tremendous successes with the multiple businesses that you worked with as an agency. What was the pivot? What made you want to go and start Legacy Capital? How did that happen?
Yeah, that's a great question. I mean, I've been a part of 6 pretty significant exits. Galileo being acquired by SoFi for $1.2 billion was one of those really significant exits. I essentially saw what I was doing and how successful I've been over the last 20 years in helping businesses grow and achieve their goals and achieve, 3 to 5 to 6x valuations on their exits. Um, and I looked at this and said, hey, I could do this myself. Right now is a great opportunity because we do have the silver tsunami. There's, 500,000 businesses going on the market in the US every year and will for the next 10 to 15 years with boomers and others looking to retire. And it's going to be, it's the largest, I can't say the hugest, the largest transfer of wealth in the United States ever. And so, I saw this opportunity. I know that I have the operating partnership expertise. And instead of having, investors go out and buy a business and try to operate it themselves, I'm like, hey, look, we're building out a fund. We have a fund that allows, investors, accredited investors, family offices, whatever, to put money into a fund. We go out, we purchase these businesses, and we operate them for you. That takes all of the operational headaches off of your plate, and it allows you to spread out your risk amongst several different companies versus just one or two acquisitions. So we're solving a huge problem, or we're providing a great solution to a current market event, and that's the silver tsunami. That's all of these businesses going on the market, all of this wealth that's exchanging hands. We're providing investors with a fund that allows them to tap into this historic market event and make some great money from it.
Totally. And just to focus in on that silver tsunami, on the moment that's going on right now, coming from the family office space and seeing, a lot thought leadership content discussions happening there. Everybody's talking like it's this beautiful thing. And you see the number that it keeps getting more and the more higher in the trillions. Like first it was 6 trillion. Now it's $10 trillion, AUM moving, and people will incorrectly label that it's family offices that it's moving towards. And there is a huge chunk there, no doubt. But that's the point, I guess, in the dilemma that you're solving or approaching. It's a lot of that capital is operating businesses, moving from one generation to the next, and a lot of that next generation, the children or grandchildren of the business owners, they don't want to run, a car wash. They don't want to run a storage company or whatever the business is. And that's a huge point of stress, I would imagine, for the founders. The kids are more educated. I mean, there's so many stories I feel like that I know anecdotally from friends and family and other colleagues. What regarding that, and it's a clear market thesis. Do you have anything that you want to add, I guess, with regards to that struggle and kind of the service that Legacy Capital is providing by doing that, using your expertise and background?
Yeah, I mean, not only do, like you just said, like not only do the next of kin, the children or the grandchildren of these business owners want to take on, a lot of times don't want to take on the responsibility of running these businesses. A lot of times they don't have the expertise either. And we focus on industries and businesses where we have the greatest amount of expertise, but where we have a track record of coming in and building these businesses up and building value for the shareholders and the investors. Of these 500,000 businesses that go on the market each year, not all of them are going to be sold. Not all of them are going to continue to operate. Either going to go under, the lowest. I would imagine the lowest 25 to 35% of these businesses aren't going to make it because the market is so saturated right now with businesses that only the most profitable, the businesses that are able to transition over to new ownership are going to survive. So we're looking as a fund only at the top 5% of businesses in the marketplace, the most profitable, and that really provides our investors with the ability to make returns from day one, because we provide distributions from the profits of these businesses that we acquire. And these businesses are already some of the most profitable on the market today. And so
Mhm.
investors are getting, returns from starting day one. So you know, we provide a solution to these business owners that are looking to sell their businesses that don't really have any other market to sell them in. They don't have next of kin, anybody that's willing to take on that business and operate it. So we come in and we provide, we become the buyer of these businesses and alleviate that pain and that headache of them trying to go out and find, operators to run and purchase their businesses.
And you're super plugged in. Like, this is something that I've learned working with you, Scott. You source between 50 to 60 deals a day, and that's very rare, I think, in this market, particularly for fund managers that are, beyond the broker network. What systems or technology or relationships do you have that allow you to keep that kind of sourcing velocity?
And that's 50 to 60 deals. That's how many deals we look at a day. But we're sent anywhere from 100 to 200 deals a day. Can't get to all of them, but usually just look at the top deals that fit our industry focus. We have relationships with business brokers throughout the U.S. So these guys are actively working with business owners to market and sell their businesses. We have agreements in place with a lot of them where they provide us with first look, first right of refusal on these businesses before they actually place them on their marketplace or set them up for public viewing, for anybody to come in and put in um, a request to learn more and do their due diligence on those businesses. And so these relationships yield, like I said, anywhere from 100 to 200 different businesses a day. We filter them down using our technology to the businesses that match, our thesis, our fund thesis, that match the industries that we're looking at, that match the business sizes that we're looking at, which is typically businesses that earn anywhere from $3 to $25 million in annual revenue, have 5 to 50 employees. So these are truly small businesses, but businesses that also hit certain numbers as far as profitability, time in business, and things of that nature. So we're looking at 50 to 60 deals a day. We also have companies that we work with, third-party companies that go out and actually do research on other businesses and find businesses that fit our thesis, and then reach out to them to see if they would be willing to sell their business. So these are deals that aren't even, that where business owners aren't even, necessarily thinking about selling their businesses right now, but we do like the due diligence up front. We find out that they're extremely profitable, and then we gauge their interest in selling that business and allowing us to come acquire it. And so we get some pretty strong deals from that as well.
And a big part of your thesis and part of the messaging that you've been putting out is that Legacy's model is operator led.
Yeah.
You guys aren't financial engineers. In your eyes, what makes an operator's playbook fundamentally stronger than financiers or financial engineers?
And the financial side is extremely important. We understand that side of it too, but we don't just come in and set unrealistic expectations with these companies and just financially strip them for all they're worth. We're not that type of private equity fund. I'm not saying there's a lot of private equity funds out there, but you hear about things in the news where private equity comes in and they fire everybody, they just gut everything, and they just do everything possible to get a quick return and flip it, within 6 months to a year. We come in and we look at businesses from, like I mentioned before, a discovery perspective, a holistic perspective, and then we build out a strategic plan with them. Uh, and then we work together as, operational partners as a private equity fund, and then people that are actually managing the day-to-day aspects of the company and setting goals and helping them achieve those goals versus just coming in and financially stripping the companies for everything that they're worth. So we'll come in and we'll provide existing management within these businesses with equity. We'll provide other key employees and people within the company with equity because we're trying to incentivize them to work with us to build these companies. We're called legacy capital for a reason. These business owners that are selling these businesses, these are their babies. These are their children. They want to see the legacy of these businesses move on, move forward, and carry on through different generations. And so we're here to come in and help them maintain the legacy of those businesses and build it, providing more jobs for more people, building wealth for the current owners and for new owners that we bring on and for existing employees. And so when we incentivize people to win when we do, then, everybody wins. And, we're actually doing something that's going to build the economy and provide jobs and make people happy. That's at the end of the day what we want to do. We want to change the world. We want to provide people with employment that they look forward to, that they, are willing to invest their time and energy in and be passionate about.
Yeah, and I appreciate that, and it's definitely congruent with your experience and values. What happens once Legacy acquires a company? What happens the first 3 months, 90 days, 100 days? Like, how's that typically look?
Well, we uncover a lot of things in the due diligence process as we're even looking at the businesses to see if we want to acquire them or if we want to provide them with a cash infusion for a portion of equity. We come in and we really get to understand the business. We look under the hood and make sure that everything is copacetic before we make a final offer and get to the point where we're actually acquiring that business. But once we've made that acquisition, it's additional discovery work. Like I said before, we're not moving straight to strategy. We're not trying to financially strip these companies. We're looking at everything within the business that works and sort of works and things that don't work. We're going to pull the levers accordingly. We're going to find, the places of the business, the parts of the business that have the highest return on investment, and we're going to continue to put additional resources behind those aspects of the business. And so sometimes you do have to make hard decisions, but within the first 3, 6, 9 months, it's going to be coming in and making the necessary changes to really align the business behind return on ads. Um, and we'll make sure that we're extremely thorough in our research and looking at all of the data, talking to everybody within the business, looking at all of the markets, looking at how the money is spent, and looking at the returns that they receive from all of the different channels that they're working within. And then making sure that we're coming in and really focusing on the things that are going to drive the most return for the business.
Excellent. And I want to hone in as well on the focus, Legacy Capital's focus on sectors like transportation, logistics, tech-enabled business to business, B2B. What do you see there that others are missing?
Well, I mean, the two industries are tied together. A lot of people don't think that there's um, a lot of businesses within the technology sector that is exchanging hands right now, but there's a lot of them. And that's where I have most of my expertise. Uh, you know, whether it's health tech, fintech, e-commerce, SaaS-based companies, transportation technology, and the way that they go together is there's a ton of transportation businesses up for sale, whether it's 3PL or freight, transportation technology companies. If you're purchasing, if you're running an e-commerce company and you're shipping goods, you need the transportation component dialed in order to maximize returns. And so, those two industries complement each other in that way. And so we're looking at, mostly transportation technology as part of our technology focus, but we are interested in looking at freight companies as well because they do complement everything we're doing on the technology side. But yeah, most of my expertise is EPL, transportation technology, fintech, healthcare technology, things of that nature.
And speaking specifically to the fund, you guys target 18 to 36-month holds with monthly LP distributions. How does that short cycle cash flow change the risk and return profile compared to traditional private equity?
That's a great question. In a lot of ways, it's their risk is reduced because we're not holding their cash as long, but we're also coming in and building these businesses over a really short amount of time. So we're exchanging that capital very quickly.
Legacy Capital targets 18 to 36-month holds with monthly LP distributions. How does that short cycle cash flow change the risk and return profile compared to traditional private equity?
That's a great question. I mean, it changes the risk profile compared to traditional private equity by shortening the amount of time that we're holding onto people's capital. But at the same time, we're also providing dividends quarterly, and we try to space out the businesses that we acquire so investors are receiving monthly distributions based on when those fiscal quarters end. I try it again. So we really help reduce the risk to investors by providing them with quarterly distributions, and a lot of cases monthly distributions based on how we align, fiscal quarters for the businesses that we acquire. And our goal is to have monthly distributions for our investors, so their they're getting their return on their investment, and breaking even typically within about a year and a half. And so that's one way we help reduce risk, quarterly, monthly, even distributions. But then we're also focused on, churning these businesses out pretty quickly. So we're really good at bringing on businesses and finding the levers to help them grow and achieve their, valuation goals in a short amount of time, whether it's 18 to 36 months, whatever. We're able to come in and really build these businesses up quickly, so investors are not only breaking even after a year and a half, they're receiving large returns whenever we sell a company. And as we achieve the full power, gosh dang it, let's move on to the next one.
Yeah, I agree. No, that's
I don't
fine,
know where
man.
to go.
Yeah. No, it's cool. We'll pivot more towards like risk, alignment, and purpose. So this is kind of drawing in more on my angle. So many family offices today are asking for more flexibility, whether that's co-investments, direct equity. How is legacy structured to accommodate that? All right, that's fine. Now, dude, that was a curveball for sure, but we'll move on. Well, no, you're good.
No, can you? It just caught me off guard. Can you say it again?
Sure. So many family offices are looking for more flexibility, whether that's co-investing or direct equity. How is legacy structured to accommodate family offices?
That's a great question. We do all sorts of different types of investments, whether it be full acquisitions, co-acquisitions or equity investments. We do it all. And for family offices, our model works really well because they don't have to come in as operational experts on the businesses that we acquire and help us run them. We do that for them. And then we're also focused on, the top 5% of businesses being sold in the US. So they have to be extremely profitable or else we're not even going to entertain acquiring those businesses. And so risk is extremely lowered when we acquire 25 small businesses that are all extremely profitable. It's unlike venture capitalism where you're coming in and you're buying 25 companies and you hope that one or two of them, work out and become the next Facebook. We're not gambling like that. We're coming in, we're lowering risk by making 25 business acquisitions, companies that are all extremely profitable and have huge potential in the marketplace for growth and for future acquisitions.
Excellent. And that leading into that, legacy plans to acquire between 15 to 25 businesses. How do you think about diversification, platform sizing, and risk management inside the fund? So let's talk about Legacy Lifeline. You launched that alongside the fund. It's the mental health initiative. Why was it important to embed this broader purpose into Legacy from the start?
I thought from the beginning it was important for us to put our money where our mouth was. And mental health care is something I'm very passionate about, something that matters a lot to me. And so really, what I wanted, the goal with Legacy Lifeline was to help other people do the same thing. So Legacy Lifeline, what it does is it helps people afford their mental health care. So whether it's diagnoses, it's treatments, it's counseling, prescriptions, whatever, if people are having a hard time affording that care, we come in and we provide those services to them at no cost, or they're able to get reimbursed for services that they've already spent money on, because we're trying to help Americans, that are currently struggling with any any aspect of mental health, we want to help them become the best possible versions of themselves. And 20% of the general partnership earnings that come to Legacy Capital are go directly to Legacy Lifeline. That's how that foundation is currently funded. This doesn't touch the LP side of things at all. So we have an 80-20 split on the fund, and 20% that we bring into the general partnership at the end of the day. Sorry, 20% of that goes directly to Legacy Lifeline to help people with their mental health.
Yeah, that's incredible. Any entrepreneur is going through, whether they realize it or not. I think that's a huge point, and a lot of people are suffering out there, and the stigma, everything's improving, I think, for whether that's, men, women, entrepreneurs, otherwise. And I think that's an excellent initiative moving forward. And this is something that I think is actually important. Maybe I should have asked it earlier, that there's a lot of noise in private markets. When you meet potential LPs, what do you wish investors truly understood about your approach?
Well, I think this comes through in our approach, but I want them to know that we really do care, that we're not just the, financial strip type of private equity fund. We're private equity partners that come in and actually want to take businesses that are already profitable, already have, a winning solution for the market, and help them grow, provide more jobs, provide, more wealth for the people that are working for these businesses. But also at the end of the day, provide, a fantastic return for our investors. Our estimated annual return is 92%. So like I said, you're breaking even on your investment within about a year and a half. We really care about our investors. We have a really close relationship with them. Whether they're a private accredited investors or family offices or institutional investors, like, we make them our family, and we get to know them really well. We make sure that they're comfortable with everything that we're doing, with our approach, with our strategy, and we're very open and transparent with how we approach our acquisitions, how we're planning to build these businesses up. Because at the end of the day, we care about changing lives and helping others and providing more jobs for the market, and providing great returns for the people that we work with.
Excellent. And last few questions here. And thanks again, Scott, for joining. When you think about the next generation of founders and operators, what advice would you give them about building something that lasts?
Oh, that's a wonderful question. I would say don't give up. We building this fund, being an emerging private equity fund, it's hard. Pivoting from being, an operational partner, an agency partner, and helping businesses grow versus doing that under the umbrella of a private equity fund has its own challenges to it. And there's been many times where I'm like, is this going to work? Like, is this going to be something that people are even interested in? And at the end of the day, yeah, we have struggles just like any other business, any other startup, or any other emerging fund. But I would say to the managers and entrepreneurs and operational partners, whoever, if they're looking to do something new, if they're looking to build something, don't give up. Keep going, because success is right at the end of that point where you want to give up. And as you keep going, as you push through and persevere, like, you're going to find success. It's only a matter of time. Keep going. Keep moving forward.
I love that. The last question from me is, if you could define the legacy you want to leave behind with Legacy Capital, what will it be?
I would say that, small businesses, small to medium-sized businesses really matter. They're the foundation of the American economy. A lot of private equity funds, they focus on larger enterprise level businesses, but there's a lot of opportunity within small businesses. Small business owners are very passionate about what they do. They want the legacy of their businesses to live on after they retire or after they exit the business. And so we're here to help those business owners do just that. Maintain the legacy of their businesses, maintain the jobs that their businesses provide, and then help them grow and create more jobs and more wealth for both investors and for the employees and for anybody else that's involved with the businesses. So if I could show people just how important small businesses are to the American economy, then great, because they're extremely vital to consumers, extremely vital to our everyday economy.
Fast forward 5 years, what would success look like for you personally and professionally?
Awesome question. For me, it would be that we'd finished up fund number one, and we were on fund number two, and focusing on the plans for fund number three. This is not going to be a one and done type of deal with legacy capital. There's so many businesses out there that are going on the market. There's so much opportunity. We're passionate about what we do, and we're going to be doing this for the next 15 years. We're hoping that our investors will say, hey, you beat out your 56% IRR. I earned more than, an average annual return of 92%. I want to re-up with you in fund 2, fund 3. I'm your investor and your partner for life. So let's keep going. Let's expand, and let's do bigger and better things every single time we have a new fund.
I love it. Thank you, Scott. I really appreciate your time. That was Scott Hauck, operator, builder, and general partner at Legacy Capital. If you found value in this episode, take a second to follow or subscribe to Founders and Fortunes on Spotify or YouTube. We'll keep bringing you conversations with the people shaping what comes next in private markets. For more information on Scott Hauck, Legacy Capital, and how to connect with him, check out the show notes below. I'm Ryan Austin. Thanks for listening to Founders and Fortunes. Take care.